Hi, everybody. Bill Prince here again. I'd like to spend a little bit of time with you in this particular video going over the decision making process in the capstone simulation. I'm going to go ahead and play a first round for you to kind of give you an idea of what all this looks like and maybe provide you with some guidance, at least as you jump into the simulation to begin with, as it is kind of foreign territory. And again, as I've indicated to a number of you, it does have a relatively high learning curve. So I kind of wanted just to let you watch what a round looks like, and then hopefully that'll kind of get you moving in the right direction. I have already signed in to the CapSim simulation, which of course you'll do, and hopefully by now you've had an opportunity to purchase the materials, the simulation itself, the CompXM, and the PETIS e-text. And I've created kind of a shell corporation here, not in the criminal sense, but just in the practice sense, which I've entitled Sensors Are Us. And this is the dashboard, and you will see something like this when you sign into your company. Keep in mind that you will be playing by yourself. In other words, you will be the sole teammate, and you will be competing against other computer teams. So there's not going to be any man-on-man competition here. It'll be you versus the simulation. So when you get on to the page, you're going to see a tutorials link that you can click and look at. There's a rehearsal tutorial that you'll need to do. This will allow you to play, I think, up to 8 practice rounds, as many as you care to kind of get you used to the feeling of the simulation and so forth. And then there's a situation analysis, which you'll need to complete. Now, these are all sort of collectively referred to as the getting started assignments on your syllabus. So that's exactly what those are. The situation analysis is basically a sort of a worksheet that will kind of give you an idea of what the market situation looks like at the beginning of the simulation and how things are likely to progress. Now, when you go down here to these blue tabs, you're going to see that there are 3 options here. There's reports, and we're going to look at those here in just a sec. There's the decisions. This is the button that you will hit when you want to begin uploading your decisions to the simulation. And then homework, and there's not going to be a whole lot of homework assigned in the simulation itself. You'll find that in the Moodle homepage. So let's go ahead and get started with the practice round 1. And I'm going to take you first to the go to decisions, and we're going to click on that, and it's going to ask you to launch the web spreadsheet. In the olden days, there used to be actually an Excel spreadsheet that you could download to your computers, but that was just a whole big mess, and so they decided just to go totally cloud-based on this. So that's where you'll do it, and so you'll be able to get to your decisions and your company through any computer that you can sign on to and connect to the internet. So when we get this up, you're going to see here's sort of the page that will help you make your decisions. And there's a number of different things here that you can look at. First of all, there's a coach, and so if you have any kind of questions or issues about what something means, what does this term mean, what does this thing do if I punch this button, the coach is a good place to go to for that. Then this is the file page, and this is where you will go to once you have made your decisions, upload them, and you can either update your official decisions to the web page, to the simulation where they will be counted once the round processes, or you can save your decisions as a draft. It also gives you the ability to undo your decisions to the beginning of the round, or just whatever you've recently done. This is the actual decision tree right here, and so as you can see, there's R&D decisions, there's marketing decisions, there's production decisions, human resource decisions, and finance decisions. And then, of course, in your simulation, as we go on, we will add to that human resources and TQM decisions as well. this tab will pull up your pro formas. Now, pro formas are what you'll want to look at once you have your decisions made, and before you upload them, to kind of see what what impact those decisions have had on your company's bottom line. And as you can see, there's a balance sheet you can look at. There's an income statement, a cash flow statement. You can look at your ratios, and then there's a balanced scorecard approach. Most of the folks tend to look at these, but these three, but these can be helpful as well. And what I would tell you about pro formas is they are not going to they're not that predictive of how you're going to do in the round, because again, obviously much of how your results end up will depend on what other teams or what other companies have done as well. So they're good to show you some big problems in your decision-making process, but not necessarily going to predict how you're going to do from round to round. And then, excuse me, we have the reports. Now, these will come to be your Bible, because these will be where all the data is stored. And these 12 reports all make up a document entitled the Capstone Courier. And the Capstone Courier is sort of the industry trade paper that sort of shows you how everything's going. So I'm going to click here on front page real quick, and this won't be particularly helpful this first time, because this is the beginning of round one, and you can see that all the teams, there's me as in Andrews, or Sensors are us, and then there's the 5 other teams. Everybody's the same because everybody kind of starts off on a level playing field in the simulation. So this doesn't tell you too much. Everybody's selected financials are about the same. Everybody's market share is identical. Stock price, bond ratings are all the same. The financials are all the same, and we're not going to go through each of these because you'll be doing these throughout the simulation. Everybody's capacity and production is the same. Their inventory is the same. And then below here, these are the market segment analysis. I can't speak today. Sorry. For each particular segment. Now, these become important for you because these are sort of where you will go from week to week to see, for example, a way to calculate your industry demand and all that sort of thing. To find out what your customers want from week to week. What are the top products that were sold? How much were they sold for? How were they positioned? What was their reliability? What was their age? And that type of thing. And so for each market segment, there will be one of these: the traditional, the low end, the high end, the performance, and the size. And so you'll be able to go to each of those segments that you're participating in and kind of see the state of each industry. And then you'll be able to see a market share report for all the segments and all the products and each company's product in that line. And then there's sort of a collective perceptual map for all segments. And so as this develops, you'll be able to see where all the products are placed, where all the segments have drifted to, and so forth. So that's, and then once we get into HR and TQM, you'll be looking at these reports as well. So that is the Capstone Courier, and you're going to be wanting to look at that in all of your decision-making processes. So let me close that real quick. There we go. And let's go to decisions. There we go. So I'm going to click on R&D, research and development. You'll make your decisions usually in this order. And there you go. Well, isn't that nice? Okay, I've got 5 products there, and there's some numbers, and there's a perceptual map over there to the right, and there's my material costs, and there's my age profile. Now, what in the world am I supposed to do with that, and how am I supposed to make decisions in any kind of cogent and consistent form? Well, with just this information, you couldn't. You would just be stabbing in the dark. And so this is where this important report comes into play, at least during the first round. You'll want to refer back to this from time to time, but once the rounds start processing, you'll be able to get a lot of this information from the Capstone Courier here. But that is a document called the Industry Conditions Report, and you should be familiar with this in having completed your situation analysis and that kind of thing. And what this Industry Condition Report does is it tells you sort of where things lie at the beginning of the simulation. So at the beginning of practice round 1, here's what your perceptual map looks like, okay? With your product segments positioned up and to the left. Now, as we talked, as the simulation goes on, these segments will consistently drift down and to the right. So from round to round, consumers want their sensors to get smaller, because again, that's what's reflected on this axis of the graph, and faster, which is reflected on this axis of the graph. So by the time round 8 comes, everything's going to sort of be down here. Now, these are important to kind of realize what they are, because again, it is within this fine cut and these rough cut circles that products will be sold. So in other words, if you make a performance product and you have it placed over here, it will not sell, because it is simply out of the area that consumers in the performance segment want. If you create a performance segment but place it in the low end, or you want a performance product but it ends up in the low end, you're probably not going to sell any because the price will be too high, and so on and so forth. So, but as we see, these segments will start to sort of move apart from one another and become a little more identifiable. But this is where everything sits at the first round. And so you can see there's a heck of a lot of crossover and a little bit of forgiveness, I guess, in the products, because a lot of them are sort of intersecting at that point in time. But that's where everything sits kind of at the beginning of round 1. Then down here, this is drift rates. So these segments will not drift in a willy-nilly fashion. You can predict from round to round where the low end is going to go, where the traditional end is going to go. And you do that through this. In other words, a traditional product each round, it's going to drift, it's going to get 0.7 faster and about 0.7 smaller. Low end, about 0.5 faster, about 0.5 slower. And again, in the situation analysis, you should be doing an exercise where it'll show you how that works. But you can predict with almost absolute certainty where these segments are going to drift to from round to round. So that's what that is. This chart will tell you that where each segment center is. So where is the center of each of these circles going to be? Now that's, it's not exactly dead middle, but we're talking about these kind of points here, which are the sweet spots, okay? So if you were to put your size and performance in exactly as the consumers wanted each and every week, you would be in the product center. Now, if the simulation was as simple as that, where all you had to do was just put in exactly what the size was the consumers wanted, what the performance was that the consumers wanted, it wouldn't be much of a challenge. But remember, they're not going to always want the exact center. They're going to look at price. They're going to look at reliability. They're going to look at age and things like that. So again, it's not just simply a matter of calculating the center, sticking it in there, and then making your buying decision based on that. So that's what that is. Let's see here. And so those are your ideal spots. Number 2, we'll talk about your segment growth rates again, and this will tell you that generally speaking, these are the rates at which your product lines are going to grow. And as you can see, there's a lot of growth, excuse me, in the high end, in the performance, and in the size categories. Okay, then number 3 here, these are your segment analysis. So for each and every product and each and every segment, you're going to be able to look at this and see what your consumers are going to want. So at the beginning of practice round 1, in a traditional product, you're going to see that your consumers want the product to be about 2 years old. They want to pay between $20 and $30 per unit. In terms of positioning, they want 5 and 15. And then in terms of reliability, they want it to be between 14 and 19,000. Okay, so look at these percentages here to the right of that criteria. And this tells you how important the consumers find these particular factors of a product. So, for example, in your traditional product, 70% of their buying decision is basically going to be based upon how old the product is and what the price is. And then 30% will be based on positioning and your reliability. So what that tells you is that your traditional product is they're interested in age. It's pretty price sensitive. They're not as concerned about it falling exactly in the product center. And then in terms of reliability, you can save a little bit of money in reliability by not making it that reliable, because again they'll settle for less because they just don't care that much about it. So and then you can go through each of the market criteria, and again you can see in low end, for example, 80%, well, almost 87, 77%. What they care about is price and age. So those are the factors you really want to focus on there. When you get into like high end here, age is incredibly important to them. Positioning is important. So you really want to focus on getting a new product out there that's fastest and smallest. And you can see that price isn't that important to them. So you can kind of really jack that price up if you're needing to. So you can go through each analysis, and we'll do that here in a second. And then there's your projected prime interest rate in round one. So that's the industry conditions report, and that is where you're going to want to start. So let's go over here for a sec. Let's pull that up. There we go. I'm gonna probably be bouncing back and forth between these reports. So here we are. There we go. Nuts. Let's see. Sorry, keep clicking on our button. There we go. So, so here is our decision-making tree for our products. So, Able. What exactly is Able? Well, Able is our traditional product. Okay, so remember that our traditional product is one that people want pretty, decently reliable. They want it pretty cheap. They want it, relatively new, but not terribly new, and that kind of thing. So our product right now is positioned here at 5.5 in terms of performance, okay, and 14.5 in terms of size, and it has a reliability of 17,500 hours. So how do we want to make decisions on that particular product? Let me see if I can find the report again. Let's see. There we go. Scooch that over there just a little bit. All right, so let's go down to our, I'm going to the buying criteria. Okay, there we go. So for traditional product, how old is it going to be? That will be reflected here. The price, we don't make any price decisions on R&D. Positioning is made with these two, performance and size, and reliability is 14,000 to 19,000. So let's do this real quick. Now this is sort of where they want it now. So you're going to have to sort of predict where it's going to be, next round. So, if we were to go to our drift rate, okay, or if we were to go to segment centers, I'm going to look at my traditional product. And at the end of round one, this would say that the traditional center would be performance 5.7, 4. Yeah, this chart is like the worstest thing in the world. 5.7, 14.3. So I'm just going to do this. I'm going to put in here 5.7 and 14.3. Okay. And again, remember, they don't care that much about reliability. In the traditional segment. That's our buying criteria. There it is. 14 to 19. Here, this is set at 17,000. So I'm going to make this 14,000. Okay. Now I'm going to hit recalculate. There we go. All right. So here's what this tells us. This tells us that this product. Let's see. We are in around. This is all. I'm going to have to get this thing corrected. But what this tells me is that this is going to come out in May of next year. So that in May of round one. So that will give you roughly 6 months of selling time or 7 months of selling time. It tells me that the age at revision is 1.7, which is pretty close to the. I apologize for going back and forth here. I'm used to doing 2 screens. Let's see what our traditional folks wanted in terms of age. Okay, they want it to be 2 years old, and that's pretty important to them. So at 1.7, that's pretty darn close. But let's go over to our perceptual map here, and you can see that the red is where the new product is, and you can see that it has not drifted very far at all. Remember that I want my products to be going down and to the right, and this has barely moved. So the R&D that I have spent has not done very much in terms of getting that product where I want to go. Now again, a lot of this is going to depend on your strategy. Are you going to be a company that's going to sort of focus on doing R&D on these high tech performance and size products and spend all your money on there? Or are you going to kind of let those alone and sort of focus on your low end and your traditional products? So that's a decision you're going to have to make. Not sure you have to make it in the first couple of practice rounds, because I think it's important that you see how all of this works. But a lot of it's going to be your strategy. So what I would probably do in something like this is I would probably say I want this product a little better. So I'm going to make my performance 5.1. Okay. And no, I'm not. I'm going to make it 6.1. I want it to be a little better. And then I'm going to make my size. I'm actually going to shrink that down to about 13.8. Now, sometimes you're just pulling numbers out of the hat, and that's fine to kind of see how that works. And then reliability on that. Again, remember, most of the time they don't care that much about. Well, let me go back. I'm looking at the wrong set of numbers here, I think. No, I'm not. Okay, that's okay. I'm going to make that about 18,000. I'm going to make it a little more reliable. There we go. And then I'm going to hit recalculate again, and let's see what happens. Slow as can be. There we go. Okay, so let's see what that's done. Well, you can see my R&D cost went up, but that's okay. And you can see I like where that looks a little better. It's not almost as indistinguishable from this year's product. It's a little better. It's pushing down and to the right a little bit. So I'm pretty happy with that. Look at that age. I've got it to 1.0. So that's how I would make the decision in terms of R&D on this. Now let's look at our low end product, Acre here. And we're going to pull up our industry conditions report again, and let's go to our segment. There we go. Where's our friend, the low end? There we go. So in the low end product, they want cheap, right? 15 to 25 bucks. Which again, we don't make that decision in the R&D page. We make that in the marketing page. They want it old, 7 years. And again, remember as I mentioned in the previous video, the only way that products age is to leave them alone. If you make any changes in terms on the R&D page in terms of performance size or MTBF, you're going to end up making your product newer and fresher. Their ideal position is they want it 1.7 to 1. I can't read to about 1.7 and 18.3. And then in terms of reliability, they don't care a whole lot. So let's go back there. So there's Acre, our low end product. I am going to, and let's see where Acre is right now. So right now, Acre is sitting, there we go, at 4.6 years of age. If we do nothing to it, it will age at the rate of 1 year, obviously, and so it'll be 5.6 next year. So I'm okay with that because again, they being the consumers, their biggest concerns are here we go, price and age. Okay, let's go down there. There we go. So where's my low end criteria? There it is. So price, and we'll fix that in the next screen, and then age. So, again, almost 80%. So I'm just going to leave that totally alone. I'm not going to make any changes to that at all, because any changes that I did would make this product newer. Okay, so let's say I'm just going to make it a little less reliable. So I'll go down to 13 on that. Let's hit recalculate. There we go. That left the price. So the product that would come out next year would be 4.6, which is where it is now, but that's not close to the 7 that I want. So I'm gonna boost that back up to 14 and hit recalculate, and voila, there we are. So I'm just gonna leave that alone until it gets closer to 7 years of age. Okay, let's look at Atom, which is our high-end product. And I'm going through this pretty quick, but hopefully you'll be able to kind of sort of get the gist of all of this. So our high-end product, again, remember that reliability is incredibly important to them. So what is it? 22 to 27. And then positioning is incredibly important to them. They want it at 9.4 size and 16.0. Price, they don't care that much about, so we'll play with price here in a little bit. And age is important to them. They want it about a year. So right now we're sitting at 8.0, 12.0, and 23. And so I'm going to fix my reliability here on my product. I'm going to boost that up about 1,000. 24,000. And then again, they want it bigger and or they want faster and smaller. So I'm going to just change that to 8.7. And again, you guys might want to play around with this a little bit. And then I'm going to shrink her down a little bit to 11.2. Now these aren't too far off my projected rates of drift and that sort of thing. And then I'm going to hit recalculate here. Let's see what happens. Okay, so there's my R&D costs. We've got a product that's about a year old, which is where they kind of want it. Right? And position, not too bad. And again, a pretty decent drift. Again, if you're developing a product, you want, you want the thing to, again, to the right and down. And I will tell you one thing, that you want to start thinking about. You're going to say, well, I might want to stay in this area. I might want to focus on these products. Some teams do this, and what they'll do is as a product starts getting older and they don't want to redevelop it, they'll just sort of leave it alone a little bit, and eventually, Atom will drift back and become your traditional product. Able will drift back and become your low-end product, and then Acre will just drift off the map, and you'll do away with it. So again, kind of thinking a little bit ahead. some teams, who are working in this front, I've seen them develop products out here, which obviously aren't going to sell until the circles catch up with them. But they're planning on that growth rate and catching and having big years when those circles catch up. So again, lots and lots of moving parts, here. So pretty happy with that. I'm gonna make some of these other decisions for aft and agape, so we can move on to some of the other decision screens. But again, I do the same thing in looking at that buying criteria and that sort of thing. So for aft, I'm going to set that at 10.1, about 0.7 bigger. I'm going to make faster. I'm going to make my size 14.8, shrink it down a little bit. And again, this is based on the buying criteria that we've looked at, and I'm just going to leave reliability alone. Okay, I'm going to hit recalculate again. Let's see what happens. There we go. So that's not maybe the best in the world, but just again, it's kind of moving to the side. But that is my sort of performance product. So again, we would expect it to kind of move more that way than that way. So that's okay. And then let's look at our size product, Agape. I'm going to make that a little bit faster, 4.5. And then in terms of size, I'm going to shrink it down about 0.6 to 10.4. And then they were quasi interested in reliability, but I'm just going to leave reliability alone at this point in time. So what I'm telling you is there's no magic answers. I mean, these are kind of trends. Let's hit recalculate and see what we got here. There we go. So I'm liking that. Okay, it's relatively conservative, but I've got most everything moving down into to the right. Again, you may want to really invest and borrow and things like that, which is fine. But that's sort of the way that we do that. And then again, you can look, here's your material costs, comparing old to new. Of course, acre stays the same since we didn't do anything to it, and you can kind of calculate that. And then this is your age profile, where the thing is starting, this round and where it's going to be next round. So again, you'll get all this from your industry conditions report, and then eventually the capstone courier. So, okay, so next I'm going to move to our next decision screen, and that is marketing. There we go. Okay, and again, what we're looking at here in marketing, the price of the product, how much you want to spend for promotion, how much you want to spend for sale, this benchmark production, which is a ridiculous number, and it'll even tell you it's useless for forecasting, your forecast, your gross revenue, your variable costs, your contribution margin, and your price less, your contribution margin less promo and sales budget. So, and then down here, this will tell you your revenue forecast and your unit sales forecast. So how do we make these decisions? Well, again, remember that Able and Acre, your traditional low-end products, these are very price sensitive. Atom, Aft, and Agape, not so much. You can set those prices a little higher. So again, where does the price come from? Well, again, let's go back to the industry conditions report. There we go. Okay, let's go down to our traditional product, Able. Right. Sometimes I get half confused here. Traditional, where are you? There we go. So the folks in traditional, 23% important, so about a fourth of their buying decision is based on price. And they want to pay somewhere in the neighborhood of between $20 and $30 per unit. So let us, let's see, why don't we just change that to $25. Okay. And we'll hit recalculate, see what happens there. Okay, look what's happened. that will tell us, where's Able? There we go. That'll calculate your costs, your variable costs, and your margin afterwards. So we've done that. So that's where you get your price information. Okay, you simply go to the industry conditions report, that this first round, and then Courier later, and it'll give you. Now, generally speaking, and kind of a rule of thumb is that each and every round, consumers expect their products to get a little cheaper as they've been out of the market. So there's usually about a 50 cent per unit decrease each and every round. So let's see, on Able, let's see here. I'm gonna jack that up. I'm gonna see, because I like Able, so I'm gonna turn that to 29.50. I'm gonna kind of price that at the upper end. Okay. And then Acre, I'm gonna set that at 24.50. And again, go to your Courier and kind of pick a price within the range. On Atom, I'm going to set that at 39.50, again, up towards the upper end. And again, I'm entering these numbers, and again, it's going to be kind of up to you to kind of look and see what impact these have and that sort of thing. Aft, again, which is not real price sensitive, upper end 34.50. And then Agape, again, I'm going to probably do that 34.50 as well. All right, so let's hit recalculate and see what that does to our margins and all that good stuff. There we go. So that don't look too bad. Now we haven't done any marketing yet, which we're going to need to do. So let's look at our budget, promo budget. Again, this makes, and I ought to mention, anytime you see one of these little eyes, you can click on that, and that will give you information about how that figure will impact the simulation. So what promo and sales does is they increase awareness of your product. If your product looks identical to another company's product, a little bit of extra money in sales and promo can sometimes be the difference between a sale and not a sale. In promo here, and I don't think it's a bad idea to just spend some money. So I'm going to spend $2,000 on that, and I'm going to spend $2,000 on my sales budget. Okay. Now look what happens to our margins and so forth once we do that. Yeah, because they shrink a little bit, don't they? But nonetheless, particularly when you're dealing with these, Able and Acre, those products are pretty fungible, and so getting those out to folks, is important. And again, kind of the same calculation that you would do. Acre, I'm going to spend some money on that, $2,000 on promo, and I'm going to spend $2,000 on sales. And again, I'm just picking these numbers out. Now, once you go back and calculate and look at what margins are, you may go, gosh, we're gonna lose money if we spend that much. So you may, want to shave that off a little bit later. Atom, let's see, we'll spend $1,500, but it's always a good idea to spend some money, at least initially, on these things. So we'll go $1,500 on that, and $1,500 on that. And again, I'm getting these numbers from nowhere but my head. So again, I'm just kind of trying. We're just go 1,200 on that. About 500, 1,200 on that. And then I'm going to do the same for Agape and this promo and sales. Oops. Okay, so let's hit recalculate. There we go. And all of a sudden you see we spent a lot more on sales. Whoops, I see a big mistake right there. And sometimes you want to do that because I do not want to spend $12,000 on that. I want to spend $1,200. There we go. All right, looks better. Okay, so again, you can see the margins start closing on a little bit, and so on and so forth. So, but that'll, again, once you do that, there's your gross revenue, your variable cost, your contribution margin, and your contribution margin less promo and sales. So 10,000 less that. So, again, if you're in a situation where you've got some pretty low margins and you want to try to get them up, you can always play around with, your promo and your sales budget. Okay, forecasting. This gets a little tricky. How many of these babies are you going to be able to sell in a given in a given round? And forecasting, I think, for many can oftentimes be the most problematic because again, your forecast is too big and you don't sell enough. You're going to end up with a bunch of inventory, and there's a lot of penalty for that. If you don't forecast enough and you stock out, then you've left a lot of sales on the table, which is not a good thing either. So, how in the world do we forecast this this simulation? Well, let's go back to our industry conditions report. And let's go down to our traditional market. Yep, tell you what, I'm going to back out of this because that does not appear on this report. We are going to go to Capstone Courier, and we're going to go to our traditional segment page. There we go. Okay, and again, this contains a lot of the same information that the industry condition report does. Where did that go? Sorry about that. There we are. What the industry conditions report has. So let me try that again. Hopefully we don't move everything around. There we go. Okay, well, I guess it's just going to do that for me. So take a peek at that and look up here at these numbers up here. So what this tells you is at the end of round 0, the total industry demand for traditional products was 7,387 units. And in round 0, which again we're getting ready to play round 1, actual industry sales was 7,387. And that accounted for 32% of the total sensor industry. And next year's growth rate is estimated to be at 9.2%. So how do you figure your forecast on this? Well, for the first round, I'm going to give you a real simple way, and you guys may, we'll talk about some more sophisticated ways later, but basically what you do, and I'm going to try to do the calculator on my computer here and see what kind of disaster that befalls us by trying to do that. If I can find the thing, where's our calculator? There it is. Okay, where are you, sir? That's weird. Huh. It's not coming up. Okay, I'm going to use my other calculator. So what we're going to do, there we go. Okay, so I'm going to take the total industry demand for this round, this current round 0, which is 7387, and I'm going to multiply that by next year's growth rate, which is 9.2%. And that gives me 679.6 additional units. So what I'm going to do is I'm going to take 679, I'm just going to round that up to 680. 680. And then I'm going to add that 680 figure to this year's industry demand, which was 7387. Which gives us then an industry demand for round 1 in this segment of roughly 8,067 units. Okay, and then so you go, well, okay, so how much of those, what percentage of those 8,000 67 units is my company going to be able to sell next round. And again, you can kind of go here. Like last round, you guys sold. Of course, everything was even, but 16%. Okay, so what this will, these numbers will start, or charts will start diverging from one another. But it will actually show what your actual market share was, and then what your potential market share was. How much did you exceed it, or how much did you fall below it? But what I always like to kind of tell folks to do for that first round is at least kind of for a ballpark. 16% is what you sold in round one. So if you take 8067 and fit, what is 16% of that? Is about 1,200 units. Okay, so 1,290 to be precise. So let's go back to our. There we go. So forecast. If you went that way, 1,290. Okay, and I'm going to then add, well, put that in there. Sorry, I had to run a dog out of the room here real quick. So let's hit recalculate and see what that does to our thing. There we go. Okay. So there again, our revenue, contribution margin, less sales, and so forth. So is that what, do I want to stick with that? It just depends. Do I think I can sell that? Do I think other teams are going to eat into that market? I don't know. So again, this kind of gets again where you're sort of sticking your finger up in the air and guessing to a little bit. I'm gonna lower that down to about 1190. Okay. Again, I'm just kind of pulling that figure out of the air, and I'm going to recalculate that. And there's what we end up with. So then I'm going to do that same process for each and every one of these segments. So again, go to the courier, take the this last year's industry demand, multiply that by the growth rate, and then that'll give you sort of a ballpark figure where your forecast is. And then again, as rounds progress, you can go higher than that or lower than that. Again, when we look at a couple later rounds, I'll show you some more techniques for that. But for this first round, let's see, we're going to do 1671 for low. Okay, and then we're going to, for our next one, we're going to, let's see, I want to forecast 424, about 425. And again, I'm doing this just by doing that same calculation that we talked about with Able, 379 and 364. There we go. Whoops. Okay. So let's hit recalculate and see, and I apologize for the dogs barking in the back. Let's hit recalculate again. There we go. Now, a lot of these numbers, are probably not going to make a lot of sense until you actually look at a processed round and see what that looks like. Let's see. Yeah, so I'm okay. I'm okay with that. Kind of low margins here on Agape and Aft, but I think everything else is looking pretty good. So that is marketing. Okay, now we're going to move on to production. Okay. There we go. And the boxes that you can fill in on production is your production schedule. How many are you going to order? And your buying and selling of capacity or factory space. And then whether or not you want automation or not. And again, obviously there's a cost associated with all of these particular things. So if you look up here, unit sales forecast, this was filled in from our marketing page, because remember we put 1,190, in there. We also have 189 units left over from inventory. Now this production schedule, this is where we'll put in actually what we're gonna make. So let's see here. We've got 1190. Okay, and we forecast that we've got 189 on hand. So let's see, 1190. I shouldn't have to use my calculator for this, but minus 189, about 1,000 units. I'm gonna be a little bit more aggressive, and I'm gonna order 1,120. Okay, just because I think that product will sell better than I've forecast. So I'm just going to do 1120 there. And then let's hit recalculate. And so then the question becomes, do I have enough capacity for that? This is my existing capacity right now. I can do 1,800 units first shift here. I can do 1,400 units first shift here. 900 units, 600 units, 600 units. So I have enough first shift capacity to do all of that. If you get into second shift, in other words, you don't have enough first shift capacity, I could produce up to 3,600 units, basically doubling it, but again, having to pay, overtime and all that kind of stuff. 2,800, 900, 600, 600 there. So, I will just tell you, it's usually cheaper in the long run to automate and have the capacity than it is to do a bunch of overtime and that kind of thing. But again, that'll be something we get into in the subsequent rounds of the decision. So we're going to do 1120 right there. Now here's the question, and I always tell people this. Spend some money. Spend some money at the beginning of the simulation. Sort of increase your capacity as you go. I will tell you, capacity is expensive, and again, but it can save you some money in the long run. So let's let me see here. So let's add 100 units. So next round, not this round, but the following round, we would have 1,900 in first shift capacity. So I'm going to hit that. And look at our maximum investment over here, 32,694. Okay. And that stayed the same because we have invested 22. So this is what we can spend in terms of buying capacity and automation this round. So I'm going to add 100 to that. Let's see, do I want to add any capacity? Well, we'll finish this out. And then in terms of automation, this is basically robots. This is adding robots to your factory that you don't pay people, you pay machines. And again, when it comes to your low end and your traditional, sometimes because you're working on a pretty close margin there, sometimes saving a few bucks in the labor area is important. So I always think automation is important. And again, I usually don't recommend that anybody get up above 8, but that's a goal to strive for. So I'm going to say we're going to add 2 more units of automation. So 6, and let's see what happens here. We'll recalculate that. And again, remember, automation and capacity does not impact this round. It'll impact the following round. So you can see that our investment went way up. We still have some room to play there, but our investment on this is up to 17,400. So those are the decisions that you would make when it comes to production. So I'm going to go ahead and again, using the same kind of calculation, which in the first round is usually just pulling numbers out of the air. I'm going to order 1,700 here. It'll be a little more aggressive. I'm going to order, let's see, an atom. I'm going to order, be a little better, 430. In aft, we're going to order, let's see, 400. And again, you can see I'm just kind of playing around these fringes of my forecast. And then on a gappy, we're going to order 375. Okay. So let's hit recalculate again. All right, there we go. And we've got plenty of capacity. No, we don't. Let's see. Do we? Let's see. Yeah, so our capacity here is only 1,400, so we're going to be getting into, because you can see here, that's what our production schedule is. This is what our capacity is, so we're going to be getting into a little bit of overtime, but that's okay for the time being. So let's go down here and let's see how much more capacity we want to buy. Okay, in acre we're going to buy. Let's see. Let's keep that. No, let's buy 100. Let's buy. I'm going to leave those alone because we got plenty of capacity. So we probably don't need to buy this round. But let's increase automation a little bit. So let's bring that up to a 7. Let's bring that up to a 4. I'm going to leave that alone. I'm going to leave that alone because I think I'm getting pretty close to my max investment on that. Oop, I actually exceeded my maximum investment on that. Okay, so when it does this, when you see these red numbers, that is not a good thing because I've obviously my maximum investment is 32 million, and I've spent 35 million. So let's see, I'm going to take this down to 6. Let's see if that helps. It does. There we go. So that looks a little better. So there's our production page. Okay. And again, just go through the first example that I used and just apply it to each and every one of these. And again, we'll do a couple more of these rounds, and I'll go into a little more detail, but I just kind of want to give you a general feel for this. So now let's go to our finance page. We shouldn't be making HR decisions at this point. There we go. And so what this tells me just at a quick glance is that our closing cash position at 2015, and I don't know why this is not calculating out for me this year, but anyway, round 0, 3,434,000, and that with all my investments and my R&D costs, we've got a big old negative cash position at this point. And again, I apologize for the dogs barking in the back. So we're gonna have to raise some money here, because again, remember, if you don't and you end up with a negative cash position at the end of the round, Big Al's going to come see you. He'll get you to 0, but at a pretty expensive rate. So let's, and again, don't hesitate to borrow money. This is just digital money. I mean, and again, I think it's always better to borrow it first and pay off as you go, rather than starting off without enough and then just kind of scraping by. So let's issue 10 million shares of stock. Now this is obviously going to have an impact on your earnings per share and that sort of thing. And let's see where that gets. Well, I didn't do. Let's see what happened here. Let's try that again. Okay. Let's hit recalculate. There we go. And so that's got us a little better. And let's see, with bonds, we can issue up to 18 million. So I'm going to issue, let's see, 10. Yeah, let's go big. Let's say 11 million there. Okay. And we calculate. There we go. So that leaves us with a pretty decent potential ending cash position. Now, as we go along, as we make money, we're probably going to want to retire stock, and we're going to want to retire debt, because interest costs and earnings per share and all that kind of stuff will impact us in the long run. But again, this first round, let's not get too much in the weeds about that. So let's go look at, so we've made all of our decisions. Let's go look at our pro formas now and see what that tells us. Let's look at our cash flow statement. Okay, we bought, so that looks okay. Again, we bought a lot of not inventory, automation and capacity. Let's see. Let's look at our income statement. Oh, I don't like aft. So again, these are not predictive. This is not how it's going to be, but it'll show you some red numbers there. So let's look at aft. Are red numbers critical and going to kill you? No, but it's probably better not to have as many. So usually what I look at when I see that is that negative margin is I'm either going to try to reduce my costs of making aft, or I'm going to try to increase my revenue on aft, and we need to go back and see where we can do that. So well, let's go to aft. I'm going to go to marketing first and see how we've got it priced. So there's aft. We've got it at $34.50. Oh, let's see what. Let's go to the courier. Let's see. Aft is ours and our sub performance, right? Let's see. Yeah. So let's see. $34.50. We got that at 35 right now. So we're kind of at the upper end of that. So let's go back. Let's see if we can tinker with marketing a little bit. Okay, so we've got aft at 1,200. I'm gonna lower that to 1,100 and 1,100. Again, you can see nothing particularly scientific about it this time. I'm just kind of pulling numbers. And let's hit recalculate. Okay. A little bit. All right, let's go back to our pro forma. Oh, we almost did it. Okay, well that's, I'm going to go, so let's do this. Another way that we can kind of monkey with this. Now, as we go along, you're going to find that like when you buy automation, that has an impact on your product life cycle and all that kind of stuff. Again, there's a million different things that we'll talk about individually as we go along. But let's go back to our decisions. Let's go back to R&D. There's aft. I'm just going to lower MT meantime to see if I can get my R&D cost down. I think that actually increased them. Okay, that didn't work. 25. Yeah. So we're gonna have to play with this on price. So let's sell that at 35 bucks. Kind of the upper window of what we could sell at, but again, it's not really price sensitive, so that shouldn't make that much of a difference. A little better, so let's see what our pro forma tells us. There we go. Okay, so again, not the highest you'd want to see, but we're all in the black there. We're showing potential net profit. So I'm looking, I'm thinking that looks pretty good. So let's go to our file and let's update our official decisions. And it'll ask if I want to save all decisions. And I'm going to click that. All decisions are ready. And I'm going to hit save. Okay, so my decisions have been uploaded to the simulation, and they are all ready to be processed. And so what we will do next time, the next video, is I will go through the debrief with you and see how well these wonderful decisions of mine, what kind of dividends they paid. So again, lots and lots of moving pieces to this thing. Don't get freaked out if you don't understand it right away, because again, I think once you play it, once you see how these numbers impact decisions, it's going to make a heck of a lot more sense to you. But again, we'll be playing a couple more of these rounds that I'll video for you, that'll hopefully give you a good idea. So if you have any questions, again, don't hesitate to holler at me, and we will visit with you again real soon. Take care.